Right then, thank you ever so much, everyone, for joining us this morning. Um, just so you know, we'll run for approximately 45 minutes, so aiming to wrap up about 9:45. Just a quick bit of housekeeping, if people could make sure that their cameras are off and stay on mute as well, that would be great. Do feel free to ask some questions along the way. We'll try to get to them at the end. We've got some time set aside for Q&A. We've got our team working in the background to make sure that we can try to get to those questions. Also, this webinar will be recorded, and this will allow us to circulate a recording of the webinar after it today as well. So a quick introduction for myself. My name is Rob Sargent. I'm a senior manager at Johnston Carmichael, and I head up our regulatory consulting team. Until about a year ago, I was at the FCA, where I supervised and authorized new and digital banks. A lot of them were transitioning from the payment space into full deposit taking licenses, so have seen some of the challenges that payments firms face, and they certainly face while scaling. We're joined by Gillian Boston, who is a financial services director and heads up our client money and client asset teams at Johnston Carmichael. Prior to joining JC, Gillian led finance and regulatory teams in both practice and the financial services sector. Moving on to Burness Paull, Caroline is a partner at Burness Paull, where she heads up the financial services regulatory team. Caroline has experience from both in-house and private practice and regularly advises payments clients on their compliance requirements. We're also joined by Marianne, who is a senior solicitor within Caroline's team at Burness Paull and has a particular interest in payments and e-money regulation. She has recently completed a secondment at a global e-money firm and therefore has first-hand knowledge of some of the challenges that firms face in practice in terms of their safeguarding procedures. Now, just to set the scene, we've seen an increase in both the number and scale of payment firms in the market, and therefore the FCA is likely to want greater supervisory and enforcement powers over these firms. The current PSRs arguably don't really provide enough legislative power and teeth for the FCA to be able to effectively supervise these firms, especially some of the really, really large firms, and safeguarding is definitely an element of that. As we know, the FCA expects payments firms to safeguard its clients' money, and we also know that we're expecting at some point a new consultation paper from the FCA enhancing these safeguarding rules. Whilst the Future of Payments review did call out some of the challenges or problems of safeguarding, we are expecting these requirements to get tougher, but we're not 100% sure what these might look like yet. Luckily, we're joined by Jill, Caroline, and Marianne, who can hopefully provide some insight of what's happened to date, what could be coming from the FCA, and critically, some practical steps to help you ensure that you're ready for what's coming. So, bearing that in mind, Gillian, could you provide us with a bit of an overview of what's happened in the past few years in the payments and safeguarding space, please?
Certainly, Rob. Thanks very much, and good morning, everyone. So yes, let's have a look at what's happened so far. So as a reminder, back in May 2020, the FCA released guidance for payment and e-money firms. Now that guidance was for firms who were covered by the electronic money regulations, the EMRs, and the payment service regulations, the PSRs. Now, the guidance from the FCA was a reminder to firms that they must have adequate controls in place to be authorised to conduct their business and adequate controls in place to safeguard customer funds, in other words, to safeguard client money. Now, the guidance also clarified that firms who are subject The guidance also clarified to firms who are subject to audit of their financial statements that they must also undertake an annual audit of their safeguarding arrangements in line with the PSRs and EMRs. Now, the FCA called out in 2020 that they recognise that payment and e-money firms typically grow quickly and that such firms were a priority to the FCA. Now, indeed, the FCA had found that some such firms hadn't implemented PSRs and EMRs as expected. So, for example, they found firms were found not to have effective risk management procedures in place. There was commingling of customer and firm funds, and in some cases, inaccurate records and accounts. Now, interestingly, at the time, many commentators considered the 2020 safeguarding guidance from the FCA to look like CAS did 10 or so years ago. And that timeline is referring to the time not long after Lehman Brothers collapsed. So indeed, the safeguarding guidance issued by the FCA was positioned as helping firms prevent harm to customers should a firm fail and returning customer funds in a timely manner. So that's really echoing the client money and client assets CAS regime. Now, we then had the Dear CEO letter issued in March 2023. Now, the FCA stated then they were concerned by the number of firms that did not have sufficiently robust controls in place, which could result in firms presenting an unacceptable risk of harm to the customers and to financial system integrity. Now, that Dear CEO letter stated 3 outcomes that the FCA expected payments firms to deliver on. Firstly, there was protecting customer money and really making this a top priority for firms. Secondly, there was ensuring financial system integrity was not compromised in respect of fraud, financial crime, and anti-money laundering. And thirdly, meeting customer needs, in particular through robust implementation of consumer duty. And note here in respect to consumer duty that payments firms had previously received a letter, actually just in the prior month, from the FCA to that effect. So it's safe to say that that Dear CEO letter in March 2023 could just have easily been issued to firms that were subject to the CAS regime. So the FCA's 2022-2025 strategy does include commitment to reducing harm to customers from firms, but the FCA remain concerned that customers' money may not be safe if payment firms fail without the necessary safeguards in place. So what does that mean for firms? Well, I think it's safe to say that the FCA expect, for example, reconciliations to be undertaken on a timely basis. The FCA expect the firms to clearly define what funds should be safeguarded, to have in place robust governance and operational frameworks, and to have processes, procedures, and controls clearly documented, and also to train staff in particular on what happens when something goes wrong, so on and so forth. And these are all things that CAS firms should also be doing now. And so, we really wait in anticipation of the FCA consultation paper. It's expected to align safeguarding requirements with the CAS rules and really, in effect, see the transfer of the PSRs and the AMRs into the FCA handbook.
Thanks, Gillian. That's really, really helpful. And it's always insightful to sort of get the view from on the ground, so to speak, of what firms are facing. It's also interesting how it correlates across different sectors. Sort of one of the things that we often saw at FCA was just making sure that firms' control environments generally, not just safeguarding, but generally kept pace with their front office and their customer numbers. And it's also really interesting to hear the comment around the CEO letter and the FCA strategy and how it all comes together. So with that in mind, Marianne and Caroline, why are the rules changing? And are there any events in particular which might have led to these changes, such as firm failures?
Yeah, thanks, Rob. It's interesting you say that it's really important at the moment for control environments to develop and at the same pace as front office. And I think that's getting ever more hard for firms to be able to comply with, because they need to be at the Usain Bolt speed of pace, I think, because there's so much change going on. So I think before we sort of delve into the specifics around this, it's kind of useful to take a step back and look at the high level and see the environment that we're sitting in at the moment. And it's safe to say that environment can be described as changing. And it's not just in the payments landscape, it's financial regulation in its entirety. And if you're immersed in this sector, if you are, that's why you're on this webinar. But you'll be clear that there's a number of initiatives in place, and that's through things like the Future Regulatory Framework Review. And that the purpose of that is to revoke and replace the retained EU law and UK laws to put them in place to govern how financial services will be regulated in the UK in the future. And I think post-Brexit, the UK is definitely seeking to continue to secure its place as the open global financial services hub and making it much more attractive jurisdiction to set up in. And it'll be interesting to see if some of these changes proposed in the payments landscape does help it meet its goal and that side of things. Because at the moment, it's safe to say that UK payment scene is definitely booming. And within the Future of Payments report that you mentioned earlier, Rob, I think there was a quote within it that said that the UK consumer benefits from a world-leading payments experience, but it could be better. So by deduction from that, it means that changes are necessary because they're definitely gaps and there's definitely areas of risk for consumers. So that's what Marianne and I are about to explore in a bit more detail into to what are those gaps and why are the rules changing. Marianne, I'll pass over to you to start this section.
Thanks, Caroline, and good morning, everyone. So I'll move on to discuss one of the key reasons why the safeguarding regime's been updated. So the current safeguarding requirements for payment firms and e-money firms are set out in statute under the PSRs and the EMRs. The rules as set out in statute are very high level and they don't contain a great amount of detail. So the FCA we do have the FCA's Payment Services and E-Money Approach document, which is the FCA's non-binding guidance setting out its approach to implementing the PSRs and EMRs. The approach does go further by way of detail and has a full chapter which is dedicated to safeguarding. However, despite this, there still are grey areas which have left room for uncertainty for firms, particularly around the approach the FCA expects firms to take in respect of, for example, when exactly the safeguarding obligation starts and ends, how reconciliation should be carried out, etc. There's also various different business models at play in the e-money and payment sphere, and firms have struggled to apply the high-level rules to their particular model, which in turn has led to differing interpretations of the rules. So for these reasons, I'm sure that a more prescriptive regime with more granular rules and guidelines would be much welcomed by firms. So I'll pass you back over to Caroline, who will discuss how firm failures and insolvencies in recent years have shown us that the regime isn't working quite as envisaged and is sometimes failing to prevent consumer harm.
Thanks, Marianne. So as Jill mentioned, from what we've seen from the FCA's Dear CEO letters, the regulator's priority for the safeguarding regime is to ensure customer funds are protected in the event that a payment or e-money firm becomes insolvent. And avoiding financial loss for customers is particularly important given there is no recourse to the Financial Services Compensation Scheme, or FSCS for short, under the current regime. So as a result of this, payments and e-money firms are expected to inform their customers they are not banks and that their funds are protected by safeguarding rather than under the FSCS scheme. And they're meant to explain the implication of this to customers in the target market in a manner that they are likely to understand. And this is so that customers can make effective and proper decisions about whether to use the product or service. You might cast your mind back to last year when everybody was definitely trying to implement the consumer duty. And as part of that, payment and e-money firms were expected to have been reviewing the way that they currently provide the information to their customers to see if there were any areas which could improve or aid consumer understanding around this point, particularly around protection. I'm not sure many firms did update the way this information was presented, but I'd be interested to see if anyone in the chat can add in some examples of firms that did update the way they in payment or e-money firms presented this information in light of consumer duty. So even being the subject to new consumer protection requirements through the new DT, I still don't think that the regime is working as envisaged. And we've seen this through a number of examples. Over the last few years, the failure of several firms has resulted in significant shortfalls in consumer funds as a result of poor or inadequate safeguarding procedures. Further, where funds have been distributed to customers, it's taken a really long time for this first distribution to be made. I think the average around this is about 2 years. So it can be, if it's a significant amount of money for a person, that's a long time to wait to be repaid. And so the inadequate safeguarding of customer funds inevitably leads to a complex and inefficient wind down in the event of a firm's failure. Wind down definitely is another priority. There's been a recent publication on this on the FCA website just this week, so it is a priority. But this sort of complex and inefficient procedure has led to insolvency practitioners having to seek direction from the court when distributing a firm's assets. So it's not clear-cut, because as Marianne said, the rules aren't particularly clear or prescriptive. There's a lot in the grey bucket, and so the insolvency practitioners go to the court for this. And some key determinations of this nature were made in one of the famous cases around this called Ipagoo. Firstly, in that case, it was found that the EMRs did not create a statutory trust over an EMI's safeguarded asset pool. And that's really important when it comes to FSCS, which I'll come back to. And two, it was determined that any shortfall in an insolvent EMI's asset pool should be topped up with the funds from the firm's other assets. And so when this case was published, these determinations were welcomed in clarifying the mechanics of the current regime. However, they did raise additional issues regarding the insolvency process, and it's likely that insolvency practitioners would continue to seek court direction in similar circumstances. And because of the court process that's required around this really adds to the cost and time burden of insolvency process, and that ultimately leads to further consumer harm. The IPICU judgment is also interesting when comparing it to the FCA's CAS regime, which Jill had mentioned previously, because CAS regime, which does create an express statutory trust over a firm's client money, and this case said that it didn't. The trust over the client's money imposes a fiduciary duty on the firm to protect client money from loss, and therefore insulates client money against the claims of other creditors of the firm, particularly in the event of insolvency.
That's really interesting, Caroline. Would you be able to dive into a little bit more detail of the implications of using a statutory trust?
Of course. So statutory trusts are interesting because they can take different forms. But if we look at them under the CAS regime, the CAS statutory trust creates a fiduciary relationship between a firm and its client, under which the client money is under the legal ownership of the firm, but it remains in the beneficial ownership of the client. Now, there's been some commentary around this, which notes that the trust in the CAS side of things is created upon receipt of funds by the firm, so it's an immediate trust. And then because it's a fiduciary relationship, this imposes further obligations on the trustees, so the firm, and as such, there's requirements around trust law, which says that the trustee must act in the best interests of beneficiaries. So through this trust regime, it can have some far-reaching implications for the way the firm operates to protect those monies on behalf of the ultimate beneficiary, the client.
Brilliant. Thank you. That's really, really interesting.
Marianne, do you have there's another case like similar to IPICU, wasn't there, we were going to chat on?
Yes, thank you, Caroline. So IPICU is certainly an interesting case. However, it's not the only example of what can happen when safeguarding goes wrong or doesn't happen at all. So as you've said, there's been a few or several firm failures in recent years, which have led to inadequate wind downs and a delayed distribution of customer funds as a result. Another example which I wanted to touch on was the failure of Premier FX Limited. So Premier FX was a foreign exchange and money remittance firm regulated under the PSRs. It went into liquidation in 2018 following the death of its sole director, and it transpired that it was a significant liability to its creditors, most of whom were consumers. As a result of Premier FX's failure to safeguard its relevant funds, 167 customers lost a total of over £10 million. For customers whose claims were accepted by a liquidator, it took a total of 3 years and 8 months until they had access to their funds. So as you can imagine, this would have caused a great deal of distress to those who didn't know whether or not they would ever recover their losses. Another interesting point about this case was that Barclays, which provided banking services to Premier FX, made a voluntary payment of over £10 million in order to make up the shortfall to the Premier FX customers. This was in addition to a hefty financial penalty which was imposed on Barclays by the FCA of almost £800,000 for failings in its oversight of the relationship. The FCA found that Barclays did not act with due skill, care and diligence in its ongoing monitoring of Premier FX, which was deemed a high-risk business due to the nature of its activities. So I think we can agree that the conclusion from recent judgments and firm failings is that clarity within the legal regime is definitely required in order to get firms to the required level of compliance with safeguarding requirements, which in turn will hopefully lead to smoother and more efficient distribution of funds in the event of a firm's insolvency. And one way of getting firms to the required level of compliance is through audits. So for more detail on audit requirements, I'm going to pass you over to Jill.
Thanks, Marianne. And that was really interesting hearing about IPIGU and Premier FX and the impact on customers and just the challenges that can arise, you know, when firms do fail. But as you say, let's have a look at audits, in particular what's in scope of a safeguarding audit. So in essence, the safeguarding audit considers the design and implementation of internal controls, as well as the operating effectiveness of key controls and processes in relation to safeguarding. Now, the types of things that auditors or consultants will focus on during an audit will include things like reviewing a firm's process, procedures and control documentation. We'll certainly be reviewing customer T's and C's, which Caroline has explained earlier how important these are. They'll be reviewing and testing those systems and controls. They'll be testing the segregation of funds. As mentioned earlier, when does safeguarding start and end? The timeliness and re-performance of reconciliations, the setup of bank accounts and treatment of mixed funds. These are all areas that will come under scrutiny. And the audit opinion itself is in whether those internal controls and processes mean that customer funds are protected. Now, from a safeguarding audit perspective, there are a few things to highlight in comparison to the CAS regime. So firstly, a firm's safeguarding audit does not need to be undertaken by an auditor per se. It can be undertaken by an external consultant. Now, that said, the firm must do their due diligence to ensure that whoever they appoint to perform the safeguarding audit has the necessary knowledge and experience to do so. But unlike a CAS audit, a safeguarding audit can currently take place whenever a firm wants it to and can cover any length of period. That said, it has to be undertaken annually, and the FCA have stated that firms may wish to align with their financial year end, but as I say, they don't have to. Now, the outcome of the audit is reported to the firm's management by the auditor and not directly to the FCA. And it's only significant breaches found that would be reported to the FCA by the auditor. Now, the FCA actually say that it's breaches of any requirements imposed by PSR or EMR that are of material significance that auditors must bring to the FCA's attention. Now, for example, that could mean breaches of safeguarding requirements where customer funds have clearly not been protected for a period of time. But firms must also think about what happens if they change their business models. You know, we're seeing these firms grow really quickly, their business models can change. So as with the CAS regime, should a firm's business model change, the firm must undertake an assessment of the impact of the changes and what impacts they have on their safeguarding arrangements. Now, if the change is material, then the FCA expect a firm to have the business model change audited in respect of compliance with the safeguarding arrangements. In other words, don't wait for the annual audit. And a good example would be whereby a firm changes from using insurance as a safeguarding method to segregation of accounts or vice versa. Now, as with CAS, a firm's senior management, they should ensure that the firm's safeguarding arrangements and governance framework reflect the firm's business model. It also needs to reflect the firm's risk and also needs to take into account the firm's growth trajectory. And of course, this is by no means a one-off exercise. This has to be an ongoing assessment. Now, the audit opinion is similar to a CAS audit report in that the audit firm is providing reasonable assurance on whether a firm has maintained organisational arrangements to comply with safeguarding requirements as set out in PSR or EMRs, and also whether the firm was in compliance with the safeguarding requirements as at the period end date. Now, it's interesting because to date, the FCA has not issued any guidance. There's no standard or framework to be used by an auditor or a consultant when undertaking a safeguarding audit. And, you know, the auditors needs to consider themselves, what is the appropriate framework or standard to be used? So, for example, there's the International Standard on Assurance Engagements issued in the UK, and that was issued in 2020. But interestingly, if you think about the term audit, that's used for statutory or CAS audits when there is an audit framework to follow. But as I said, to date, no standard has been issued for safeguarding. So by comparison, for CAS auditors, or rather for CAS audits, we have to use the Financial Reporting Council standard that's called Providing Assurance on Client Assets to the FCA. So with the hopefully imminent FCA consultation paper coming, we may see some framework being referred to in that consultation paper.
That's really helpful. Thank you, Gillian. I think it's really, really interesting to hear sort of at the beginning what's happened to date, and then sort of what failures have been leading to this becoming such an area of focus, and then what the key differences are between CAS audits and safeguarding audits and things like that. And it really brings us to a point of sort of, okay, right, so what next, I guess. So Gillian and Caroline, I'd be really keen to hear your thoughts. What do you think we can expect in the future? What might sort of safeguarding 2.0, so to speak, look like?
Shall I go first here, Caroline? I think so. The FCA have made it really clear they want to absorb PSR and EMR rules into FCA handbook. I was in another webinar recently, and the guy from the FCA made that absolutely clear. So I think given the FCA's continued focus on client protection as a high priority, we could well see additional chapters in the CAS handbook specifically for payment and e-money providers. I do think audit requirements will tighten and, mirror that of the CAS audit regime with prescribed deadlines. And again, I've talked about the audit framework. Potentially there will be an audit framework to follow as well. And I think the audit opinion will have to be submitted by an auditor to the FCA. And I think that'll again fall in line with the CAS regime, where it has to be 4 months after the period end date. And we may well see the requirement for audit firms having to undertake safeguarding audits going forward, which, as you know, as I've said, isn't currently a requirement.
Yeah, really, really interesting. Thank you, Gillian. Oh, have we got an echo? Let's try again. Is that, there we go. That seems to be a bit better. Sorry, everyone. Really, really interesting. Thank you. And I think it's also really important just to, as Caroline did earlier, so this all linked to consumer duty and that proactivity that's required for firms to demonstrate that they're acting in the best interests of consumers. And I think sort of in terms of the tone of what's to come, I think if we look back over the last few weeks, sort of the survey that's gone out to insurance intermediaries, questions asked to financial advisors, the consultation paper on enforcement last week as well, whilst they're not obviously specifically related to safeguarding, it really does show you that assertiveness that the FCA is now really demonstrating, and I think we can only assume that the CP on safeguarding is going to be similarly assertive. And I think it's also quite likely that the FCA will likely want to get more sight on the external assurance of safeguarding arrangements. Whether or not this becomes a formal requirement for all, or something that firms have to just sort of demonstrate throughout their ongoing supervisory activity, is yet to be seen. And obviously there will probably be an element of proportionality to this. And could we see maybe a bucketing like we do with CAS firms of small, medium and large payments firms having different requirements within their safeguarding audit requirements and expectations from the FCA. But Caroline and Marianne, be also really keen to hear your thoughts.
Do you want me to jump in, Caroline?
Go for it.
I'm not sure I'll be saying anything particularly groundbreaking here that we've not already alluded to, but I think we can quite confidently say that the new regime will be more prescriptive, contain firm-facing rules, as opposed to the high-level requirements in statute. And these rules will hopefully provide more detail on the things that firms struggle with, so operational tasks around, for example, when firms should be safeguarded, as well as more detail on the systems and controls that firms should have in place to protect customer funds. While this will be welcomed, the level of detail included in the new rules remains to be seen. I'm not sure if firms should expect the holy grail that will solve all their problems, because safeguarding is a very complex task. There can't be a one-size-fits-all boilerplate approach, given the diversity of business models in the sector. So I think firms should still expect to have to apply their minds in order to assess how the new rules will apply to their particular operations, depending on how exactly funds flow through their business and the exact activities that they carry out.
Thanks, Marianne. It's interesting. I think I'm on a similar view to everybody that's spoken so far, but I think I'm going to sort of touch on sort of the consumer duty side of things, I think, as well, because I think that given the lack of huge changes that were apparently implemented by payments and e-money firms to update operations to meet the consumer duty, I agree that sort of principle-based high-level regulation in this context might not work. So I agree that we will see much more prescriptive rules setting out requirements that must be complied with in order to safeguard funds in the payment space. I think if consumer duty was the carrot, then safeguarding 2.0 will be the stick, and there will definitely be, given the direction of travel of the FCA, as Rob mentioned earlier, I think that there will be more teeth for the FCA to sort of really enforce this and make sure they've got more control over the way that funds are held. In addition, and a quite interesting point, I think that if we go down the statutory trust route, then I think we might end up seeing an extension of the FSCS to cover payments and e-money firm failure. And this, I know that I opened by saying how under the future regulatory framework, the UK Treasury and the regulators are really trying to make the UK one of the best places to set up and operate your financial services company. But I think if this extends to create the statutory trust over the funds, then whilst it's great for consumer protection, it's going to potentially create a barrier to entry for new payments firms, because inevitably it will become more expensive to operate where there's a levy involved in order to fund the FSCS. And just for context, why I think the FSCS will be extended to cover these firms in the future if we go down the statutory trust route. This comes directly from the PRA's depositor protection rules, because the trust model triggers protection, and it's all about who is the absolutely entitled to the funds in a bank account, in an account. And under the trust regime, we know that the underlying customer is absolutely entitled to the eligible deposit, and therefore then they're pulled in to the protection scheme. And in fact, the depositor protection rules also set out that and kind of specifically state that an eligible deposit is where there is a person that is a beneficiary of a bare trust. So it's definitely something that was a consideration, and the cost of a potential levy being enforced, but also the costs involved with the more structured audit regime that Jill touched upon, means that it might become a more expensive sector to operate in. But I don't think that's the only consideration as well, is it, Marianne? Because we've been given some thought about some cross-border considerations where the UK kind of moves to diverge away from the European regulations. There's a lot going on in Europe at the moment, isn't there?
Yeah, Caroline, so just wanted to touch on this before we finish up or move on to questions. Just mention the fact that there is scope for potential divergence between the EU and UK regimes. So the PSRs and the EMRs are derived from European directives, which means that the UK and EU's payments and e-money reg regimes are broadly aligned, and that's remained the case largely post-Brexit. However, as Caroline's mentioned, the government has set out proposals in its future of regulatory framework review, which means that there's potential for divergence in the wider payments landscape between the UK and the EU, and this includes in approaches to safeguarding. You'll probably be aware that there's a lot of changes underway in the payments world in the EU as well as the UK. So the current Payment Services Directive, PSD2, will soon be replaced by PSD3, as well as a new payment services regulation in order to make changes to keep up with developments in the payments market. The European Commission has confirmed that safeguarding rules will be largely unchanged. However, some changes will be introduced. These are primarily in relation to concentration risk, which is the risks involved where funds are safeguarded in one single credit institution. The European Banking Authority will develop regulatory technical standards on risk avoidance and safeguarding of customer funds. So we can't quite say yet what the extent of any divergence will be, given that we're not sure what the UK regime will look like exactly. However, firms that operate on a cross-border basis should definitely be mindful of the potential for divergence and consider any impact this might have on their business operations and their compliance procedures. I'm not sure if you wanted to add anything, Caroline.
Yeah, no, I was going to say that's a really interesting point. I think that definitely on the sort of the horizon scanning pads of any firms operating in this sector who have maybe got a footprint or plan to have a footprint in other European countries, they really need to monitor the evolution of the European and the UK regimes in tandem, and also sort of trying to identify the kind of areas where divergence and how that will impact in operations. This is something that I know, Marianne, that you know that we regularly help clients with already, because there is a divergence, and we often will have to engage with local council in many different jurisdictions where our payments firms are trying to map out the sort of evolution of their operations throughout various European countries. So it's already an issue. I think as we sort of maybe get further away from the European regime, it might be even more difficult, and I suspect in future there's potential that it will have big impacts on the way that these firms operate, particularly around safeguarding, where it might be that in one jurisdiction you've got a prescriptive set of rules that you must comply with, and it's very different than others. So it's going to be one to watch, definitely. But I think it's safe to say that all of this is just going to create more work for firms, which is a shame, because it seems like it's an endless pad of change for overpayments and e-money clients.
Thank you so much, Caroline, and everyone else. I think it's been a really, really insightful sort of perspective on what might be coming. And I think Caroline, just to echo your views, it really does sound like sort of the hard work is it's kind of only beginning, really, unfortunately. And I think it's a really, really tough blend of sort of fast-growing firms, quite high risk to customers, multi-jurisdictional, and then sort of a new outcomes-based regulatory framework kind of combines to create this melting pot for firms. But it's been really, really interesting to hear where you guys think things might be going, where they came from as well, sort of the enforcement points and things from that. And I think it's now time to open up really to questions. I'll kick off with one of my own, sort of maybe just a really quite quick one. Guys, when do you think this CP might drop?
Good question. I think I don't know, Jill, if you've got a view on this, but my personal view is any day I think we'll be expecting this, and if not towards the end of this quarter, at the very start of quarter 2. Jill?
I did think quarter 2, Caroline, but I'm going to stick my neck out and say I don't think we're going to see it to quarter 3.
Right.
I may be proved it might actually drop today. Who knows? But no, I think it will be a shade after summer.
And how do and if you think it will be after summer, when do you think the changes will be required to be implemented by? This is a good question.
About this, weren't we? I think it's going to be. I do think there's going to be quite a bit of change, and I think obviously we've talked about that today. So I think it's going to be a 12-month lead time. I'd be surprised if it's shorter. Or do you think it'll be shorter?
I feel like there've been quite a lot of changes that have been required to be implemented by firms with a much shorter lead time, and this one technically should be not in terms of actually the operation around it. It could be quite a quick fix. So I wouldn't be surprised if we see a very short 3 to 6 month lead time once the rules are published. What do you think, Rob?
I think it's a really interesting one. I think I wonder if it could be slightly iterative as well, where sort of there'll be some immediate sort of 3 to 6 month fixes, and then sort of the overall framework could sort of have a slightly later deadline, especially if there's requirements for sort of external collaboration as well. So maybe sort of some of the points around getting up to speed and getting up to standard, especially given that this is a sector where, as you touched on earlier, there's been some failures or sort of problems that we've seen taking 2 years for customers to get money back on failures and reconciliations. But maybe sort of some of the big ticket stuff could take a little bit longer. We've just had another question come in relating to the treatment of relevant funds and when funds become applicable for safeguarding. Are the FCA moving towards immediate safeguarding obligations, or will they keep existing timeframes if funds are held overnight? Caroline, I'll probably go to you first there.
Let me just go into the cupboard and grab my crystal ball for this one. I think it's difficult to say. I think who knows what the FCA will do in the future, but I'm not thinking the FCA will be massively pragmatic in their approach, and it could because of the draconian way they are implementing things recently. So I think it might be sort of immediate protection, but I would be interested to see what anybody else thinks.
I agree, Caroline. But I do think we'll see it tighten. I think it has to be almost immediate. If you look at what happens in the CAS space, I think it will tighten.
Really interesting. Thank you. Still got a few minutes. If anyone else has got any further questions.
Hi, another question from me, it's John speaking. Do you see them going down a cash resolution pack and the kind of to assist with wind downs and the formalization of your overall business structure from a safeguarding point of view via a resolution pack?
Shall I take that one first? I think we will see that, or some form of that. I think, given going back to examples that we've seen today about how long it's taken some firms to return money, we're talking years. I think the FCA will expect to completely move away from that. So I think we will see a resolution pack in some way, shape, or form for safeguarding.
Yeah, I think it's inevitable. I think just kind of the direction of the FCA, everything they're doing at the moment in order to sort of protect consumer interests and kind of having the consumer at the heart, I think it's definite.
Thank you.
Thanks both. That was a really interesting question. Thanks, Jan. Probably got time for one more if anyone's got anything before we wrap up for this morning's session. Or failing that, we can call it a day and thank all of our panelists for joining us this morning, and of course all of you, and thank you for your engagement. We have actually sorry, I will rewind because we've just had one come in. What approach should firms be taking to add further controls to their safeguarding reconciliations with a likely move towards CAS reconciliations?
Jill, this one's got your name on it, I think.
My name all over it, this one, hasn't it? I think that's a really interesting question. I think there's some firms who know more about the CAS regime than others. They don't have to follow it right now. But I would start having a look in particular around your reconciliations, how the timeliness of your reconciliations, the accessibility of the data that you have to your reconciliations. Do you genuinely understand the breaks that are occurring in your reconciliations? How quickly can you get to those? What I'm saying here is actually common sense. If we're all basically saying we think the rules are going to tighten, so really have a think about how you're doing your reconciliations, how robust they are. Are people who are doing them, do they really understand what they're doing? What are the ramifications if something does go wrong? And always remember what's the implication on the customer. When we look at CAS, we always have to have that, and certainly from a CAS audit perspective, we have to look at it from an insolvency mindset, i.e. if something does go wrong, is the money genuinely protected, or money or assets genuinely protected, and how quickly can we get those back to the customer? Your reconciliation tells you an awful lot, and your reconciliation should actually be at customer level, certainly from a CAS perspective. So think about that. Are your reconciliations at that granular level, customer level, and how quickly can you resolve your breaks and actually stop ones that are genuine operational issues from happening again? I could talk about this all day, I won't, but I think really think about, are your recs good enough, and would they be good enough if they have to follow the CAS regime going forward?
I have another question. Do you see increased reporting like the client money asset return for the payment space, and kind of monthly reporting to the FCA on safeguarding performance?
I think quite possibly we could. I think, to echo what Caroline said, I mean, ultimately this is all about client protection. Submitting reports to the FCA, having audits, safeguarding audits, that auditors are eyes and ears in effect for the FCA. So I think the FCA themselves need to be seen to be doing what they say they're going to do, and that is prioritise client protection. So again, potentially we may well see that.
Caroline, any final words from you as well?
No, I agree. I think anything at the moment with FCA, it's sort of all, it's all more, I think, more burden, more controls, more paperwork, more evidence. And I think that's exactly what's going to happen with this. So I think it's for firms, I would say, brace yourself, keep an eye on what's happening to make sure that you are ready to implement any operational changes, especially if the FCA command that they're done in a tight timescale, which is my prediction.
Brilliant. Thank you ever so much, everyone, both our panelists and everyone in attendance. We've run ever so slightly over, so apologies, but I think we'll call it a day there. And yeah, thank you all ever so much for joining.